Bull call spread. It's a vertical call spread where you buy one call and sell another call at a higher strike price. So you're going long one call and short a call. The time to use a trade like this, like the name implies, is when you're bullish. You think the market will go up, but you're unsure of how high, or you feel that the upside potential could be limited. Or you think the market will go up and the straight call option is very expensive and you want to be able to reduce not only your cost but your risk by selling and getting a call option with a closer strike price to the money. The profit on a trade like this is limited to the difference between the two strike prices, or the spread. At expiration, the break-even is equal to the buy-side strike price plus the net amount paid for the spread. The risk is limited to the amount paid for the spread, and the maximum loss is reached if at expiration the market is below the purchased or long option leg. Here's an example of a bull call spread in the Dow Jones. We're buying a 104 call, which is our primary option, and now that option is looking like it's going to cost about $1,145. Now, in order to reduce our cost and our risk, we're going to sell a 106 call, creating a spread, a 104-106 spread. Now, the profit potential on a trade like this is limited to the amount between the spread. In this case, 200 Dow points or $2,000. Now, by selling a 106 call, we're collecting this $485. As you can see here, we actually get filled at different prices because the market goes up, but our net out-of-pocket cost is $800, not including commission. Now, that gives us an intrinsic break-even of 104.80. How we arrive at the intrinsic break-even is we take the amount we pay for the 104 call, subtract the amount we collect on the 106 call, and we get $800. You take $800 to convert it into Dow points, which is 80 Dow points, and you add it onto your strike price of 104. Thus, you get an intrinsic break-even of 104.80. Now, the intrinsic break-even is your line in the sand. Anything above that line is profit. Anything below that line will result in a loss. Of course, if at expiration the market is below 104, at or below 104, you'll lose the entire amount you paid for the spread, like a regular call option. However, your risk is limited. Again, your profit potential is limited as well to the distance between 104 and 106. Regardless of how high the market goes, that's the most you'll make. Now, if the market goes up to 106 right away, there will be the extrinsic value factor of the 106 call will be prohibitive in collecting the full 200 Dow points. We'll show you an example here. 28 days later, the market goes higher, and it's beyond the 106 call. However, the extrinsic value on the 106 call is outweighing the extrinsic value on the 104 call. So in other words, even though the market's over 300 points higher than where you got in, you can only collect $1,590 net on the spread. Now, this is called this will go away as the market goes deeper and deeper in the money, as you can see here. Going into option expiration, which is the purple line, the market, both options are deep in the money, thus there's no extrinsic value, and you can collect the full 200 points of intrinsic value. This is a bull call spread.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and training techniques by industry leaders. This should not be considered as a solicitation to buy, sell, or invest in securities, options, futures, or Forex. Remember, trading does involve the risk of loss. Past performance is not indicative of future results. Stocks, futures, options, and Forex trading is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.